Good morning. Welcome you all. It is my pleasure to introduce Mr. Anil Grandhi. He is our guest today, and it's a very important topic, how to save money. We are very hard earning people, and sometimes we don't know, we just, the ways how legally we can save our money. So it is my pleasure to introduce Mr. Anil Grandhi, founder and CEO, AGFinTax, CPS Inc., AGFinTax. On behalf of Central Florida Indian community, welcome you, sir.
Thank you, sir. Thank you.
Mr. Anil Grandhi, he has 19 plus years of experience in finance profession as a finance controller, CFO, and other senior executive positions. Worked in Amazon, Starbucks, PWG, and Sun Edition. He was recognized as the top 20 CEOs of 22 in USA, also accepted by Forbes into Forbes Finance Council member. He has a team of 50 plus members, including CPAs, CAs, and other finance professionals. He has been serving clients, including individuals and the business clients throughout the USA on tax planning, tax returns, filing, bookkeeping, and CFO services. Sir, here it is, the platform, and please let us know every penny, how can we save from our hard-earned income? Thank you.
Thank you. Thank you very much. Thanks to this Central Florida Indian Association, Indian community, and also Srinivas and Madhu for taking this initiative to share the knowledge, to bring this finance knowledge to your community. And thanks. And for the next 45 minutes, which I'm going to present, I try every minute to bring value to our community members who are spending their time in a weekend. So it is not easy to spend time. We all know how busy we are in a weekend, but it's great you're guys spending time. And good morning, everyone. And thank you very much for joining in the weekend. And people may be thinking, why do I need to know about taxes now? It is not the season, or it is not tax filing season, or we are not much worried about taxes. Why we're worried about taxes very much now? So the thing here is, as Srinivas is saying, for every dollar we earn after putting a lot of efforts, day and night, and also spending their weekends, or maybe taking a lot of stress to earn that every dollar, we are spending 30 to 40% of every dollar we earn as taxes. We're just putting a donation box. We're putting in the donation box into the IRS. Yes, it is law, and everyone has to pay taxes. I'm not asking you to not pay taxes. Everyone has to pay the taxes. But legally, there are many ways how you reduce our tax liability. Just Google search later how multi-millionaires, billionaires are paying taxes. If we look at the very successful business owners, they pay very less taxes legally. So they are not behind the bars. They are running their business. They're making millions and billions. But how much money we are earning and how much taxes we are paying on every year on year. The reason is their person, whoever is actually able to save taxes, either they spend their time to learn the taxes to some extent, or they work with the right people. But what we do is, we don't have time to learn few basic things. We are very busy in our life. I understand we all are busy. We spend time for our vacation. We spend time to play poker in the late nights. We spend time to chit chat with our friends. But how much time and efforts we're actually spending or investing for our own future? And so if and during the year, again, November, December, or maybe during the tax season, Everyone is very busy in filing the taxes. At that time, if you want someone to learn, there is nothing much you can do because the year end is over. So there are a lot of ways. Today, I'm going to share few of the ideas. Okay, it may not be the complete list, but considering the shortage of the time, I try to share whatever I can. And if you need more sessions, more different topics, you can come up with any topic. I'm very knowledgeable. I can talk on a lot of topics. You can work with Srinivas or Madhu to schedule more also on different topics. But today, let's focus all our attention on how we can save taxes legally. The money, whatever we save, maybe few thousands of dollars, how we can invest for our future, for maybe for the kids' education, or maybe for our retirement planning. So let's get into the topic now. So I always say, we need to be proactive, not reactive. That is what we say, 2023 proactive tax planning. It's not a reactive. So we need to, before end of the year, if we need to take some action items, let's take some steps. So, and Srinivas already briefed about me, but this is a very high level summary. I have almost right now, we have 90 to 20 years of experience as a finance controller and CFO positions. I'm in a core finance guy. I'm not in IT. I'm in a core finance guy. So over the 20 years of experience, we learned so much. I work with big corporates, Amazon, Starbucks, PricewaterhouseCoopers, and a few other organizations. I'm trying to bring those great knowledge, what I attained there, to our community. In this process, I am also the Forbes recognized me and Forbes allowed me to be, I'm the Forbes Finance Council member for the last few years. And also last year, I was also awarded as a top 20 CEOs of America. You can Google search about me to get more and to find more about me. Just search for Anil Grandhi. You will find few hundreds to thousands of pages about me. And all this success is not because of me. I have a great team who is supporting me. We are total around 50 plus professional team, CPA, chartered accountants, and also other finance professionals. So how do we know? Are we working with the right professional or not? Because you are not expected to learn everything which is there in the 70 pages of tax code. You are not expected to decode it. Every person has their own strengths. You might be a doctor, you might be an engineer, you may be an IT professional, but are you expected to know everything in the taxes? May not be. But at least your success depends on with whom you work. So how do you know, are you working with the right professional or not? The first just think, when was the last time your CPA or an accountant came to you and say that, come on, here is a tax saving opportunity, let's start saving it. At least will he send some email to you with the latest updates, or will he come and sit with you to talk about not at the filing of tax return? How many times you are meeting you're an accountant or CPA in the year? That will decide your success. So, and you may think, Anil, I understand from my CPA, there is not much opportunity to save taxes. Really, do you really need to worry about all these tax savings? You can say, even you are able to save few thousands of dollars. I know that the opportunities might be less specifically if you are on W2. Even you are able to save few thousands of dollars. And if you start investing those thousands for your retirement planning, those few thousands may become millions by the time of retirement. So that's what I say. Next 30-40 minutes are very, very important for you to learn something and start implementing. Don't just be like watching a movie. Come on, you enjoy the movie. Maybe after coming out from the movie theater, you will forget everything in the next 5-10 minutes. That should not be the case, because this is your life, your financial position for the future. What level you want to retire, what level you want to take care of your kids financially. So there may be a lot of value points would be there in the next 30 minutes. So try to make a note and try to take an action to implement that. So if I start with the basics, I know recently in the last couple of years, a lot of NRIs are coming to US to start earning money or for the studies. So I want to start with the very basics. Do I need to pay taxes for every dollar we earn in America? Answer is may not be, because we have some standard deductions. It means if you're an individual or a business owner, for the first few thousands of dollars, you don't need to pay taxes. But after that, what happens? After that, we get into the tax bracket model, where your income will decide in what tax bracket you are. If you are making some $200,000, your tax rate is different compared to your friend who is making $500,000 per year. So the tax rate will change based on what income level you are. So we have two types of returns. If you are in W2 employment, every one of us has to file a tax return as long as we make more than at least $27,700 for the business. It is a $13,850 for an individual. So basically, we have two types of tax returns we file individually every year. By April 15th, we have to file taxes. It's called 1040 tax return. We have two types: standard return, itemized return. What is a standard return? Standard return is a very straightforward. What is your income level? There are some standard deduction. That is, as I was saying, that you don't need to pay taxes for the first 13,850 or an individual, or if you're married filing jointly for filing, then it is $27,700. You don't need to pay any taxes. On top of that, you do also get few more deductions. If you contribute to HSA, if you contribute to retirement accounts like 401k, IRA, or if you're doing any charitable contributions, you may be eligible to get some more deductions subject to you are meeting the criteria appropriately. And if you think that, Anil, why I need to get a tax deduction only for $27,700? Is there any way to deduct more? Answer is yes. That is called itemized. What does it mean? IRS has identified or listed down few types of expenses. If you add all those together, if it exceeds the standard deduction, that is $27,700 for the married filing jointly, then you can go for itemized. So you can claim more tax deductions. So what is a tax deduction? Whatever money you make, income, that's an income. Whatever deductions, the deductions, net taxable income, the total income in the first level. Next, what are the deductions you have, you can claim. Then you get a net taxable income. That is where you need to pay taxes. So the more deductions you have, the lesser tax liability you will end up. So we always need to look into that legally, how we can deduct few taxes, few expenses, or few things, how we can deduct in our tax return. So at a high level, if you look into this, if you are incurring any medical and dental expenses substantially, not in general. What is a substantially definition? It should be 7.5% of your total income, more than that. If total income, if like example, if any family emergency has taken place at your home, or any of your family member met an accident, in those circumstances, we might need to spend more money from our pocket for our medical and dental expenses. Then if it's exceeding 7.5%, then that comes under this category. Then SALT. SALT is state and local taxes. So state and local taxes are like it's a $10,000 up to the $10,000. I mean, I know that in Florida doesn't have a state taxes, but if you are paying any property taxes, that also comes under this state and local taxes. So the property tax also included here, and also if you are paying any home mortgage interest, that is also deductible here. And if you're doing any charitable deduction here, all this together, if it's exceeds standard deduction, then you can claim more deductions, which will help you to reduce your tax liability. So first you should ask your CPA or an accountant when you file your taxes, am I going for an itemized or not? If not, I mean, everyone may not be eligible because this total up should exceed $27,700. Otherwise, you will not be eligible under itemized. So then home mortgage. So which is a very common question which I get on home mortgage. Can I claim 100% of my home mortgage interest? Answer is no, because the tax code says the home mortgage loan, if you're buying the house after 2017, then if to the mortgage loan amount of up to $750,000 only, you can claim it as a mortgage interest deduction. If, like example, if you have $1 million mortgage loan, then what is to be done? Proportionately. So proportionate up to $750,000, whatever interest attains calculates, only that amount is tax deductible. And interestingly, you can claim 2 primary houses as tax deduction. Like example, if you have a house in India, or you may have a vacation house in maybe in some other place, maybe in Los Angeles, or maybe in Texas. If you have any second house, that also claimed as a primary house, provided you are not giving that house for the rent. So you have to stay when it can be even like example, if you may have house in India, your parents may be living, but whenever you travel to India, you are using that house as a vacation house. Even that also is also considered as a under this calculations. You can claim two mortgage interest on the two primary houses. Then very important strategy. Many people might not using this, or they might have heard this, but they're not implementing this, because this is health savings account. This is very important. This is one of the best tax saving strategy if you are eligible for them. So HSA is like it's an online account. Every year you contribute some money into this account. You get a tax deduction for this money, but this money has to be used for only medical expenses only. That is what. So that the expenses, you can use it forever in your lifetime. There is no expiry. So like example. So not example, for this year, for the year 2023, you can contribute up to $7,750 into this account. Like example, if you are in higher tax bracket of maybe around 35% or 37%, then imagine how much money, approximately $2,500 literally, instead of paying to IRS, by paying $7,500, by contributing $7,500, you are saving $2,500 in your pocket instead of paying to IRS. So once you put the money here, once you contribute the money into the HSA account, this money can be used for any medical expenses in your lifetime. There is no expiry. You don't need to use it immediately. You can use it after 10 years, 20 years, 30 years, 50 years also. Maybe after retire, I use this money. Till the time I just start accumulating the funds. That is the one. From when I contribute, I get the tax deduction. This money can be used immediately for our out-of-pocket expenses or maybe deductibles, medical deductibles. But my recommendation, don't even use it immediately, because this money can be invested in the stock market also. And the money can grow tax-free forever in your lifetime. Like example, this year I contributed $7,750. What many people use, even if you already have an HSA account, generally what people do is they use this card to swipe whenever you go for a medical for a doctor to meet the doctor. They use this card. Don't do it. Rather, call your HSA service provider and ask for how you can start investing this money into your stock market. If you can, this $7,750, if I can invest in blue chip companies or Sensex companies, or the top blue chip companies, maybe some 20-30 companies you can pick, and you can just start investing this in the next 20, 30, 40 years. The $7,500 and $7,700 may become $50,000 by the time of my retirement. And this money is completely tax-free withdrawal as long as you have for medical expenses. You can use it for your medical expenses, for you, for your spouse, and also for your dependents. For any reason after the retirement, hey Anil, I am very healthy, even after at the age of 70, I cannot use these funds. Okay, you can withdraw money also, but you need to pay taxes at that time. You don't need to pay now, but if at all, if you're not able to use it for medical expenses, then I recommend you can withdraw, but you can decide it later. At least start contributing. We don't know, we cannot foresee how healthy I will be by the time of retirement. Then capital gain. I know we all, as I'm talking with an Indian community right now, we all invest in most of whatever money we make. We can eat only so much. The balance money, what you do, we invest somewhere. Where generally most of our Indians, if we look into that, either we invest in the real estate or we invest in the stock market. Most of them. So these both the products, both the assets, whenever you sell them, you need to pay capital gain taxes, which is different from in regular income tax rates. The capital gain tax rates are different. So, and there are some tax saving strategies are available which you can implement it. So I won't be, there are so many out there, but I won't be able to explain everything now in this call, but I will explain a couple of them. And in this, this is like a teaser. Just imagine like whatever I'm talking today is like a teaser. which I'm sharing to the community. But if you want to learn more, if you have some specific scenario where you need a specific guidance, you can schedule a meeting with me or with our team. We are very happy to help you. So the first and most capital gain tax savings. If you are having a primary house, if you live over there for at least 2 years in the last 5 years, and if you're selling the primary home, because we all know our homes got appreciated now, every one of us, if you have a house already in US, if you're holding the property for the last couple of years, I'm sure you have noticed the appraisal already. I mean, our home values got up. If you are selling those properties, you get a capital gain, but you don't need to pay capital gain taxes up to $500,000 capital gain. You don't need to pay any taxes if you're married filing jointly, if it is a primary home sale. Then we, in the last couple of years, we all notice a lot of up and down in tax stock market. For suppose if your investment, wherever you are investing in the stock market, if the market is down, don't get panic first. You can sell the stock, book those losses, and you can adjust, knock it off these losses with any other capital gains, not only this year, at any time in the future. Like example, in the future, maybe after 10 years, I may be selling my real estate property, or maybe after 5 years, I may be selling some other stock market, some other stock or shares. So if I'm incurring any capital gains in the future also, these losses today, if I have example, I invested in maybe some XYZ company and the market is down now. So for the stock, I can sell the stock right now. I can book those losses and keep it in my pocket. These losses can be adjusted either this year, next year, or next year, at any time in the future with any other capital gains. So if the market is down, if your stock investments are down, yes, don't get panic. You can invest you can adjust these losses with any other capital gains in the future. Then 1031 exchange. If you are having any capital gain through real estate, like example, if you are selling a property and if you are getting a capital gain on the sale of a real estate property, then you have an option to go invest in 1031 exchange. It is like you can reinvest the entire sale proceeds to buy some other like-minded property. So if you can find something like that, you can reinvest. So then you can defer your capital gain taxes. Please note, you have to go through this transaction, the 1031 exchange program, before you take your sale proceeds into your hand. That means you should not touch your sale proceeds whenever you sell the property. You need to appoint a third-party service provider who can create an escrow account. The entire sale proceeds will get into that escrow account. From there, you can use the money to buy some other property within 180 days. I'm just giving it very high-level details just to bring some knowledge and awareness. So within 180 days, you have to buy some other like-minded property. And okay, Anil, I already sold the property. Right now, I have a capital gains. Now, what to do now? I didn't know about 1031 exchange. So then you can go for an opportunity zone investments. What does it mean? There are two benefits. You can defer your capital gain taxes. Number two, you can even save some taxes even in the future also. I will explain this. If I am getting any capital gain on the sale of a property or a business or on the stock market, whatever taxes I make, or whatever the capital gain I get, I can reinvest this entire capital gain, not the entire sale process, only capital gain amount. I can reinvest into some other opportunity zone funds or property. So how do you know opportunity zone funds? You can Google says government identify few areas where there is a need of economic growth. If you are investing in those funds or opportunity in those properties, you can defer your capital gain tax payment till 2027. Like example, today, if I'm selling an Amazon stock for worth of $500,000 worth of Amazon stock I'm selling, I made a capital gain of $100,000. If it is a short-term capital gain, I need to pay around 37% in taxes, 40% as a short-term capital gain taxes. If it is a long-term capital gain, it is a 23.8. Instead of paying this $40,000 in taxes, this entire the capital gain amount of $100,000 can be invested into this opportunity zone funds. So this capital gain taxes can be deferred till 2027. Until 2026. Sorry. This should be 2027. Sorry, there is a typo. So you can pay the tax of the taxes on this 100,000 capital gain. You can pay in 2027. I hope you are clear. So then this 100,000 I invested in a property now in the opportunity zone, and if I can hold this property for at least 10 years, the invested property. After 10 years, if you're selling the property, if I'm making any capital gain on that property, it's also completely 100% tax free. So there are two things. Number one, I am deferring my capital gain tax payment till 2027. First advantage. Second advantage, if I'm holding this property for at least 10 years and selling it, then I can save taxes on complete. If I'm saving taxes, if I'm holding the property for at least 10 years, then I can save taxes 100% on the sale of this invested property again. Then one of my favorite topic, tax planning for the real estate investors. I always encourage people to diversify your investments. If you're investing only in the stock market, definitely you should consider the real estate investments also. Even you have some $20,000, $50,000 also in the cash, my recommendation is go and buy real estate property because those are tangible investments. I am not a real estate agent, but I will try to bring what are the advantages you have as a real estate investor. So I strongly recommend every of my client, my friends, my family to buy at least one real estate property every year. You may be thinking, how can I buy every year one property? Yes, you at least even you can save $20,000-$50,000. You should be able to save. You should be able to buy one property. You don't need to buy property in a very expensive areas. You can even there are so many places in America which can where the condos are available for $100,000, $200,000 also. So there are a lot of advantages when you buy real estate property. Number one, power of leverage. You don't need to invest the 100% of the value of the property. You just need to invest maybe 20 to 30% of the value of the property, but you enjoy the appreciation on 100% of the value. If I look at that last 100, 200 years of history in America, real estate market may go down temporarily here and there, but again it will bounce back. So don't look for short term, look for long term and enjoy the appreciation. And once you pay 20-30% as a down payment, the balance 70% who will pay? Not you, not your tenant will pay you the balance loan, 70% of the loan. And there are a lot of tax advantages. And whenever you buy a property, I strongly recommend you to look for cash flow. Buy property which can generate a passive cash flow, not only for this year, forever in your lifetime. This you can create a legacy for your next generation. Buy 5 to 10 properties every month. If you can generate maybe $10,000 of cash as a positive cash flow after paying your EMIs, that's the big money. That's a passive income inflow. If you can generate around $10,000 positive cash flow, you are ready for the retirement. Stop working for someone. Work on where you are passionate. You just need to generate a passive income flow. Once you have the real estate property, you can claim a lot of tax. You can claim a lot of expenses also. Mortgage interest, depreciation, computer, tools, supplies, utilities, labor. All these expenses can be directed against your rental income. And there are so many other advantages on the real estate property. I can have a separate webinar on tax planning strategies for the real estate investors. But we don't have the lot of time, so I'm just touching at very high level. And retirement planning. In America, the average savings, an average American resident, if you see, the average savings for the retirement is less than 1 to 2%. It's a fact. There are statistic reports for it. But so that what government has done, government started offering a lot of benefits, tax saving opportunities if you start planning for your future. In India, you don't have so many saving opportunities like this. But in US, because the people don't save for their future, government is offering a lot of tax benefits to encourage them to start saving for the future. But as we know, as we all know, we all are highly qualified people, and our average incomes are much higher than average American resident. So American citizen. So what we need to do? We need to start optimize all these tax saving opportunities. So there are so many different types of retirement plans are there, but we don't have time to go through everything. But I will try to tap few areas now. So basically, when we talk about retirement planning, we should know about two basic concepts: traditional, Roth. Traditional, very simple understanding, what you contribute in your 401k at your employment. Every year you pay some contribution, you do some contribution, you enjoy the tax benefit. But in the future, whenever you take the money out, you have to pay taxes. So, and the Roth works in a different way. Roth contribution, Roth account, you can actually have a Roth even with your 401k. Okay, when I was working for full time with Amazon, I was contributing to Roth 401k, not regular 401k, because Roth works like this. Whatever money you contribute to Roth 401k, you don't get any tax deductions for that year. But in the future, whenever I withdraw money, completely tax-free forever in my lifetime. I don't need to pay any taxes on the earnings as long as I meet all the criteria. So there is the basic differences. So I have seen many of us are not even contributed to the 401k. This is one of the best plan for our future to save taxes also. You may be thinking, Anil, I am on H1B, or I may be going back to India. Do you really, is 401k worth for you? Worth for me? Yes, answer is yes. Because if you can start contributing 401k, you can contribute up to $22,500. The day you contribute, immediately you get 20, 30, 40% in tax savings based on your income level. You tell me one more investment opportunity in America where when you contribute money, immediately you enjoy 30, 40% savings. You cannot. So 401k is one of the best plans. You should optimize it. And I know, I understand your concerns, but there are different ways how you can withdraw 401k also by paying some taxes. There are a lot of investment opportunities. You can use this money for investing into a lot of things also, which I will cover it in the next slides. But if you have any specific questions on this, I will answer. And don't ever lose your free money. That is your employer matching. If your employer matching, please don't even lose $1. Please first blindly just contribute up to that level. After that, if you have money, start contributing to the 401k. Instead of investing somewhere, first start optimize your retirement plans. Then go, if you have extra money, then go and invest in some other companies or some other places. So then if you are running a business, you can contribute to the SEP IRA. SEP IRA, you can contribute up to you can contribute up to $66,000 for the year 2023. You can even contribute for the last year also, for 2022. Now, if you are running a small business, you may be a real estate agent, you may be a photographer, you may be running a kitchen at your home. If you're showing any business income or tax return, you can do contribution to SEP IRA even for the last year, for the year 2022, if you have not yet filed your tax returns. Before filing a tax returns of October 15, you can contribute to SEP IRA. Then solo 401k. Solo 401k is also like, if you are running a small business, you can contribute up to $66,000 for this year 2023. Imagine if you can contribute $66,000, and if you have an income of, maybe if you're in higher tax bracket of maybe 37%, how much taxes we are going to save? Approximately $20,000 to $25,000 per year. Instead of paying to IRS, you are keeping $20,000 to $25,000 in your pocket. You can do this only when you have a business. Otherwise, you cannot do solo 401k. So I always encourage people to have a business. And donor advisor fund. And if you want to do some charities for the future, you can open an online donor advisor fund. You can start contributing to the donor advisor fund now. And whatever money you contribute, you get a tax deduction. The total amount you can contribute for your charities are generally 60%, up to the 60% of your AGI, adjusted gross income. So whatever money you contribute, you enjoy the tax benefits immediately, but this money can be used to donate to any charitable organizations, that is 501c organizations in America at any time in the future. So you can start saving money Enjoy the tax benefits now. In the future, you can decide where do you want to how do you want to use these charitable donations. Then IRA. I noticed many of us are not having IRA accounts. I am surprised why. Because there are a lot of advantages by having an IRA account. When we have an IRA account, every year we can contribute $6,500 for our IRA accounts. For us, for $6,500, even for a spouse can also contribute $6,500, even though she is not working. Okay, Anil, so you have time till April 2024 next year, April 15th, to contribute to IRA. So then if whatever money you contribute, you enjoy the tax deductions immediately. But however, there are some income limitations. If your income is more than $138,000 married filing jointly, even though you contribute money, you will not get tax deduction. You can contribute, no one can stop you, but you will not get a tax deduction for that. So, but if your income is less, definitely you should go for IRA. If your income is more, I will tell you other options. Then you do also have one more option called Roth IRA. Instead of paying for IRA and enjoying the tax benefits, if I am you, I will contribute to the Roth IRA and I don't want any tax benefits now, but I will enjoy the tax benefits in the future forever because I already explained about Roth. And if you look at the numbers, so but can everyone contribute to the Roth IRA? Answer is no. If your income is more than $228,000 married filing jointly, doors are locked for Roth IRA. So if your income is less than $228,000, without fail, every year, please contribute every year for you and for your wife $6,500 each. This is one of the best, one of the best one to have. Every one of us should have Roth IRA account. Okay, how can everyone have? You may say that, Anil, my income is more than $228,000. How can I have a Roth IRA account? That is where the other options are there. If we look into the multi-millionaires, there are so many millionaires, billionaires, they have the Roth IRA account. I want to give one example. There is a guy called Peter Thiel. He is the co-founder for Facebook, and he's a co-founder for he was one of the director for the Facebook and is a co-founder for PayPal. So how does this? This guy has in Roth IRA account, he has $5 billion. As you already know now, what is a Roth IRA? You don't need to pay any taxes on this entire money. He is not yet retired. Once he retires, he can take this entire $5 billion, but he doesn't need to pay any taxes. Then you can ask me, Anil, my incomes are more than $228,000. I am not able to contribute, but how others are able to do it? That is where the other things, that's called backdoor Roth IRA. So when your incomes are more than $228,000, I know your CPA accountant would have told you, hey, don't contribute to the IRA account at all. You are not eligible, because most 85% of accountants or CPAs in America, they restrict their knowledge only to the tax return. If you claim if your income is more than $200,000 to $138,000, if you go and put any money for the Roth IRA IRA account, you don't get any tax deductions. Then they stop their thinking. But actually, if you think beyond, there is a concept called a backdoor Roth IRA. What is it? If you follow me in the last couple of slides, whatever money you contribute to the traditional IRA, if your income is more, you will not get a tax deduction. It is okay, but you can convert that money to the Roth IRA. You have to disclose this contribution as non-deductible traditional IRA contribution, $6,500. So invest in your traditional Roth IRA as a non-deductible tax IRA contribution. Convert that to the Roth, because you didn't enjoy any tax benefits when you contribute. The conversion time also, you don't need to pay any taxes, only on this money. But there is a small, very precaution you have to take. If you have any traditional IRA accounts already, we all may have a traditional IRA accounts. If you already have any traditional IRA account, you should convert them to the Roth IRA by paying taxes even before do this backdoor Roth IRA. The other option is, if you already have a traditional IRA, you can roll over those balances to your 401k account without paying any taxes. So in simple summary, whenever you want to do Roth IRA account, to backdoor Roth IRA, you should not have any balance in your traditional IRA accounts. You may have an account, a balance already that has to be washed out. Then only you can have a backdoor Roth IRA. If you don't have traditional IRA account, don't need to worry anything. Open two accounts, IRA account, Roth IRA account, contribute to traditional IRA, roll it over to the backdoor Roth IRA. Simple. If you want to more, you can do Google search also, or you can ask me questions also. I'm happy to answer. This is how you build your Roth IRA account. Whatever the money, like example, I will tell you, Anil, why you are spending so much money, so much time on the Roth IRA? I will tell you an example. In the last 10 years, if you would have saved, if contributed 6,000 on average every year for me and for my wife, around how much money I would have saved? Around $120,000 in my Roth IRA account. Maybe backdoor or straight Roth or whatever Roth. If you have my balance in Roth IRA for $120,000, this $120,000, I can invest every year wherever I want forever in my lifetime. This year I invest in the stock market, maybe next year in the real estate, maybe next year in the cryptocurrency, maybe in the startups, pre-IPOs, or maybe even I can give a loan to my friend for interest. I can do any of those things. When whatever I make money, because example, if I invest in the stock market, I make some money, correct? That is the plan in the next 5-10 years. Whatever money I make, I need to pay zero taxes. I don't need to pay any taxes forever in my lifetime. So backdoor Roth IRAs are very, very important. So there are some myths. People think, hey, and it's many people come and tell me, my CPA told me to not invest in the IRA account because I'm not eligible. That is wrong. And you can open Roth IRA account even though you have a 401k account. 401k is through employer and IRA is a non-employer program. You can do both together, and you can have Roth IRA, traditional IRA, but the maximum you can contribute is $6,500 per year. And this money can be invested either in the stock market, if you're having an account with a Fidelity, Vanguard, or Pro big companies, or you can even invest in the stock market, real estate, cryptocurrency, but you need to have a self-directed Roth IRA for those accounts. And so this is what the backdoor Roth IRA. So contribute money. Instead of front entry, there is a back entry. So contribute to the backdoor Roth IRA. This is 100% legal. I'm telling whatever today I'm telling, everything has a supporting, and it's legally only I'm talking about. And okay, now you understand the power of Roth. Anil, I have some balances, Roth 401k, regular 401k account from my previous companies. Please convert them to the Roth. Whenever you do the conversion, please note you have to pay taxes if you're converting a rollover 401ks. But once you pay taxes, forever you don't need to pay any taxes in the life on the earnings. So please work with an accountant or CPA, or at least send an email to me. We are happy to help you and guide you what is right. Because when you do the conversion, you need to pay taxes on that. And general business tax deductions. There are so many advantages when you run a business in America. I strongly recommend every one of you to have some business at least in the side. If you are just on W2, the opportunity to save taxes are very less. But if you have a business, you're opening up the doors to save a lot of taxes. Your average tax rate will go down only when you have, with having a business. So if you have any passion, please start a business. Convert your passion into the business. When I was working for a full-time in Amazon, I started with I started my company, AGFinTax. Then I converted that into a full-time business because I started enjoying on what I am doing. On top of that, I enjoy a lot of tax deductions also. I can claim home office expenses, travel expenses, meals expenses, or healthcare expenses, and any startup costs also. All these expenses can be claimed only when you have a business. Please note that don't misuse any of those things. You can claim these expenses only when you can demonstrate there is a business need, there is a support in documentation, and if it is a legitimate only, you can claim all these expenses. But if you're on W2, You can't claim even $1 against all these expenses. So, and home office expenses, like if you are on W2, can you claim your home office because last 2-3 years you are working from the home? You are consuming electricity, you spend some money for your home office renovations. Do you really, can you claim any of those expenses? Answer is no. But if you're a business, you can claim home office expenses. And if you are a business owner, if you're having a car, all your car expenses are tax deductible, fuel, gas, maintenance, repairs are tax deductible. And also, you can also claim depreciation. The depreciation is if the value of the property, 80% of the value of the property, like of the car, like example, if I am buying a Land Rover, the value is on road is $100,000, but I can claim $80,000 one flat tax deduction in this year if I'm having the business. But the vehicle has to be more than 6,001 pounds in weight. If that is the case, then you can claim that these depreciations also. Then, if you're already having a small business, if you're running like example, you may be a real estate agent, or you may be doing some other part-time financial advisor, okay, or maybe you're an insurance agent. If you are having a small business and if you're making more than $50,000 in net profit, I strongly recommend you to convert your business into the S Corp election, because you don't need to pay social security taxes. 15.3% social security taxes you don't need to pay if you are having an S Corp election, if you are doing S Corp election. Then very most frequent questions which I get on FBAR, and I do also get a lot of questions on repatriation of funds. I am not going to talk about that right now, because we can have one more session exclusively on how we can get the funds from India. We all have investments in India. How do we get those funds? We can have separate exclusive webinar on that separately. But for now, let's focus on FBAR and FATCA reporting. If we have, because we all are immigrants here, if we have more than $10,000 in any foreign financial accounts, that is in India, in your bank account, if you have that money, more than $10,000 aggregated. If you have multiple accounts, all these accounts together, at any point of time, even for 1 minute, if the total amount exceeds $10,000, you have to file FBAR, foreign bank account reporting, with Department of Treasury in America. It is a mandatory. If you are not doing it, at least start doing it now, because there are a lot of interest and penalties will be levied. For penalties will be levied, not interest, penalties will be levied if you are not doing any filing. And so what is this foreign the definition of foreign financial accounts includes bank accounts, savings accounts, fixed deposits, securities, stock exchange, stock market, mutual funds, or investments in any private companies, and LIC policies, any insurance policies. If you have a cash value in your life insurance in India or any other country other than America, then you have to file FBAR. Please note, FBAR doesn't include real estate. Hey Anil, I have a real estate property in India. Do I need to report here? No. This is only for the foreign financial accounts. The definition of financial doesn't include real estate. And the due date to file FBAR is April 15th. But if you are not yet filed last year, at least you can file before October 15th also. If you don't file it, there will be a lot of penalties. And if you have more than $100,000 as of end of this year in those foreign financial accounts, same definition, there is a separate, the first one we spoke about, FBAR, for $10,000. If you have more than $100,000, I do also have clients who has more than $100,000 in India in bank accounts. So then they need to file Form 8938. This is a separate reporting which we need to do with IRS. So the secret ingredient of any successful decision, successful financial planning is working with the right team. Just ensure your team is strong, you will be successful. It's like just working in an organization. Even though you're working on a W2, your team will decide your success. In the same way, your financial future is decided based on with whom you work. So people think, hey, I can save my money on taxes by just doing a Google search or talking with an half of knowledge friend. But actually, if you have a proper planning, you can save a lot more money in taxes legally, ethically, and morally also. And if you are having a business, if you are having a business owner, schedule a meeting with me. I'm happy to sit with you one-on-one to do a free tax assessment and help you on taking the decisions. If your income is more than, at least your net profit should be more than $100,000. If your income is more than, net profit from your business is more than $100,000, just send an email to me. I will have a one-on-one meeting with you. So to guide you, of course, it will be a paid services which we can guide you. And if you and many people think, hey, at least how to change my accountant or CPA? It's a very easy process. People think it is complex, but it is a very, very simple process. You need to have last couple of years of tax returns. If you are running a business, you need to have your books of accounts. That's it. You can change it at any time in the year. If you have not yet filed your tax returns, we are happy to file tax returns for you this year. And so we at AGFinTax, we use very state-of-art tax filing process where we developed our tools where everything, our CRMs, billing, security, documents upload, everything is completely integrated at one platform. Everything can be seen, everything is very well integrated, and you can also see the pipeline, like what is the status of the tax return at any point of time. So and if you want to sign up for any newsletters, you can just scan the barcode. You can sign up for the newsletters. We share a lot of information with our community. And if you want to talk to me, or if you have any questions, send an email to me or call us to schedule a meeting. Based on if you are a business owner, if you're an individual, send an email. I'm happy to answer your questions. If you have any more questions also, please feel free to drop it in chat box. I'm happy to answer here. Thank you very much. Thanks for this opportunity to Central Florida Indian community. Thanks for the great opportunity. I will take up the questions now. Thank you.
I think, thank you, Mr. Anil. Thanks for, thanks for giving, lot of tips. I think already everyone might have a lot of dollars in their pocket by this time, going through all your tips. I think they will work with their CPA, or, they may come to you. So, but it's a very knowledgeable session actually for tax savings. And after all savings, I like one thing. From CFIC, I like one thing. After saving all your taxes, at least partly they can do donor advisory fund.
Yes.
So they can save more also by doing that one also. So
yes.
Thank you. And we can do some other sessions for especially how to bring the money from India, from the, whatever the properties, and how we can do, separate session on that. Actually, it's a big session. So now I think some people put some questions. Can you look into the chat box, and can you please try to answer those, please?
Okay, HSA is on top of the standard deductions. Answer is yes. Yes, Prasanna. Yes. Just 1 second. Yep. Then did you mention transferring all money from traditional IRA to Roth 401k is tax-free? But to Roth account, we have to pay cess. Answer is yes. Yes, Deepthi, you are right. If you're transferring your traditional IRA to 401k, it's a tax-free. There's no taxable event there. But if you're transferring to the Roth, if you touch Roth, you need to pay taxes on the conversion. You're right, Deepthi. Thanks for the informative sessions. And one quick, how is our pricing structure? Are there different levels? Okay. Hi, Om. So our pricing structure is just like a restaurant menu. You go, you eat idli, vada, dosa, puri. You keep adding the things. It will be price changes in the same way, because some people may have a real estate properties. Some may have one property. Some may have 10 properties. Some may have a stock market investments. Some may have investments in India. So it depends on person to person. But we have a standard pricing structure. So if at all, if you're working with it, then you will have an access. We will give you the quote also for your services. So if you're okay, then we can move forward. But it depends per person to person, it changes. Thank you for good information. And thanks to, okay, what is an advantage of buying one house in a year? Joy. Okay, I think I covered that already. So, but let me explain in more detail. one of the way how you build your net worth is by investing into real estate investments. If you look at the top billionaires, most of the more than 50% have come up through I don't want to use up 50%, but many of them came through real estate investments. And all multi-millionaires, billionaires invest their money into the real estate because first thing, it is a tangible. And you don't need to pay 100% of the value of the property. But what is the why you need to invest every one property every year? I'm just encouraging a habit. So if you can make it as a habit, in the next 5-10 years, you can build some 10 properties. On average, even you can make per month, per each property, $500, 10 properties, $5,000 passive income. If you can generate, imagine forever in your lifetime, even after your expiry, your next generation also will continue to enjoy the passive cash flow. So there is no other system like that. If you invest in the stock market, you may not get a passive guaranteed cash flows. Or if even you have W2, there is no guarantee for your W2 job forever, but your real estate property has a guarantee. So yeah, okay. So thank you. Is Roth IRA benefit is Roth IRA a benefit if household income is more than 200,000? Answer is yes. Even you make $1 million, still Roth IRA is great because our tax rates are going to shoot up, and it is already in high. And as we all are Indians, we all are high net worth profile people, and we are very well educated. By the time of our retirement, our income levels will be up, and also the tax rate also will be up, because right now America is in very bad position in the debt from the debt perspective. How do they repay the American? How do they repay their loans? Only by increasing our tax rates. One of the ways by increasing the tax rates. So my recommendation, irrespective of your income levels, Roth IRA is one of the greatest strategy. So that once you have the money in the Roth, imagine this money, you can use it for whatever you need, for whatever purpose you need throughout the years, throughout your lifetime. You don't need to pay any taxes at all. Thank you, Deepti. Thank you for the information. Another question, does it make sense to prepay the mortgage on the existing properties or buy more investing properties at 7% current rate? Should we keep the full 15-year mortgage? Deepti, one more very good question. Right now, the stock market is not, the real estate interest market rate is not great. I understand it. If you are buying, I assume you have not bought any property in the recent times. By default, I don't recommend in general, not for this year, because this year interest rates are very high. But in general, I don't encourage anyone to repay your primary home mortgage loan. If you have more money, go and buy more properties, build your net worth. Our primary home interest rates is one of the cheapest loan available for us. So it's okay to have the loan as long as you have the real property to support the loan. So rather repaying your mortgage loan, my recommendation is go and buy more properties. But for now, interest rates are high. Be very, take strategic decisions, do your own analysis, then only invest. Otherwise, my recommendation is wait for some more time. Maybe next year, once the interest rates goes down, then you can start investing. Okay, so. And you need to you can never time the market. You have to do the averaging out. Buy one property this year, next year, but continue to buy irrespective of the interest, as long as you have a positive cash flow from the property. Don't care whether you have what interest rate you have, as long as you have a positive cash flow every month. And later you can refinance it also. So Joy, so we can buy more than one as an investment and still claim benefits. Answer is yes. More than one house per year means, for benefits. Answer is yes. There is, okay. If we have more than, I should say 8 to 10 properties, many more tax planning opportunities will come into the picture. As I said, I can have a separate one more webinar on tax planning strategies for the real estate investors. At least till 8 years, till you get 8 properties, you follow one tax saving strategies. But once you cross 8 properties, a lot more tax planning opportunities are there. Do I need to pay taxes for profit when I sell my primary home, where I stayed in house for more than 5 years? Okay, Gopi, I think I will repeat the clause again. If you live in the property for at least 2 years in the last 5 years, you can live for more than 5 years also. You don't need to pay any taxes on your capital gain taxes for the first $500,000 of capital gain. So primary house sale is completely tax-free up to $500,000 if you meet the conditions. Joy, how do we sign up for the free session with you today? We can come up with you to our office or can call. Joy, I am in Dallas. I'm based out of Dallas, and we can have a Zoom call. And my CPA, actually, I don't know whether he's there in the call or not. Abhishek Gandhi. He's based out of Orlando. He's in Orlando. But you can have a Zoom call. But as I said, with you today, you can sign up a call. But as I said, if you are a business owner, if you're having more than $100,000 net profit, then we can set up a free assessment call with me. You can send an email to me. I already shared my contact details earlier. You can set up a call meeting with me. Then I'm happy to send an email to me if you want to talk. So then we can help you on that.
So,
or otherwise, you can even call me. Also call our office. So one of our team member also can help you on setting up the meeting.
So Anil ji, this question, is there going to be a link for this recorded session for those who miss? We are going to upload this recorded session to CFIC YouTube channel. We have the YouTube channel. We are going to upload this session, whatever today recorded. Yes, thank you.
Yeah. Okay. And yeah, this is recorded. So you should get a copy of it. Yeah. And Vamshi Reddy, with regard to the property gain tax, if a partial property is sold, can I reduce the base number, then prorate the purchase and the sale numbers? The purchase and sale. Answer is yes. Yes, you are right. You are right, Vamshi. Yes. If you're selling a part of the property, then yes, you can prorate it.
Hey, Anil, this is KK. I have one question. So regarding I keep hearing that regarding the Roth IRA, backdoor Roth IRA, people talk about more than, 50K, 60K, jumbo. I don't know, they give a lot of other names. Can you shed some light on that?
Yeah, it's called mega backdoor because we already put so much of information here. I don't want to confuse the people. So generally, if you look into my AGFinTax webpage, okay, there are so many webinars where I spoke about mega backdoor Roth IRA. You can go through my AGFinTax webpage. You can see a lot of information I share. But anyway, answering to your question right now, if you are working for a big corporates, okay, so I will show you a list. So if you are working for a big corporates like Amazon, Microsoft, or maybe Google, T-Mobile, so there's a few big corporates are there. They offer a concept called mega backdoor. You can also do this if you're a self-employed, if you're a real estate agent, or if you're a photographer or any other self-employed. The concept is you can contribute up to $63,000 into mega backdoor Roth IRA. It is like you are clear on $22,500 as an employee contribution. On top, after that, you have one second, let me take out the slide. It will be easier because you specifically asked. Let me help you.
Yeah, because I own a business also. I'm on W2. My wife owns a business. We make more than 100K. So that's why
Sure. Very good.
CFIC got connected to me. So
just give me a minute. So this is now whatever he's asking is a bit complex. Everyone may not able to understand, but because there is a question I'm answering. So ignore if you're not able to follow it. Yep, I'm sharing my screen. Okay. So if you look into this mega backdoor. Yes. Okay. So in general, this is called mega backdoor. Under the mega backdoor, you can contribute up to in total $72,500 a person can contribute. Either you should work in those big corporates or you should have a self-employment. So under the self-employment, so these are the three levels. Number one, Roth IRA, which I hope you understood already, which I explained in detail. Then $22,500 as an employee contribution you can contribute. Then there is one more concept called after tax. This is the word, keyword, after tax. So how does this work is the difference between $66,000 and all this money plus any employer matching. If you can deduct whatever the money you get, you can create one more account called after tax. That is, you contribute the money there, you don't get any tax deduction for that, but that money can be rolled over to the Roth IRA on the day two. So there are three. Number one, two. So this is a complex. Then there is an employer match, number three. Then it's called after tax. If you can meet all those things per year, you can contribute $72,500. Imagine such a big money. And this grows tax-free forever in your lifetime. So I hope you understood now.
Yeah, absolutely. I think this is great info. Thank you so much. I didn't had a proper clarity on this for a long time now. I think this gives a better clarity. Thank you so much.
Yep, no problem. Thank you. So these are the small basic things. So these are very, very important. And that's what I said. And actually that's what we say. What we do is for all our clients, every client, you can call anyone your friend in whole America. Open your mobile phone, call anyone in America. How many times you meet an accountant or CPA, ask him, they say only one time when they file taxes. We are unique in the industry. After filing our taxes, we meet every client again. In the busy March, April, if you come, we file taxes. But how do you plan for this year? We will have a one-on-one meeting with every client every year. That is the beauty. We chase you for scheduling the meetings. So then we will explain all the strategies based on your needs, based on your eligibilities and everything. Yeah. And if you are a business owner, we also help. We have been helping few hundreds of clients, business owners, in designing a road plan to save taxes legally. So if you are a business owner, schedule a meeting with me. Directly, you can just send an email. I already shared the contacts here. So I did also share my business owners WhatsApp group link here. If you are a business owner, just be part of the business owners WhatsApp group. You do also have my access of my WhatsApp also, direct to access. You can even ping me at any time also, or otherwise you can call me. You can schedule a meeting as possible. Yeah. But if you are an individual, I cannot have one-on-one call with every individual. As you understand, we're talking about a lot of hundreds of people. Practically, it is not possible. But if you're a business owner, definitely I'm happy to help in 100. If you're for a free assessment, if you have net profit of more than $100,000. If you're an individual, send an email to me. I'm happy to answer your questions. Thank you, sir. Thank you very much, Srinivas. Sir, you are on mute.
There is one other question, Anil Garu.
Yes.
If any previous year's FBAR submission not done, can we submit now? From Suresh Makapati Garu.
Okay, Suresh Garu, there is a couple of ways. First, you can go back and file your FBAR for the last 6 years. You can go to the Department of Treasury FBAR and you can do it. That is the level one. But if you have really bigger balances, then IRS has come up with a concept called streamlining process, where if you're not disclosing your interest incomes on your India savings, then you might need to amend your last year's tax returns also, because you have to disclose those incomes. So there is a concept called streamlining process. If you need that process, send an email to me. We can help you there. But there is a bit complex process. If you don't have a lot of balances, you can just go and file a bar for the last few years directly. If you have major balances, definitely have to go through a streamlining process. And if you are not done, at least start from now. Of course, you have an option to go back and do it. At least bite the bullet from now, and from now, at least start doing it.
Thank you, Anil Garu. I
Yes, sir.
think this session also we are going to end now. So thank you very much for all your time and your knowledge sharing. So definitely it is going to help a lot of individuals and the business owners in our Central Florida community. And thank you all for joining today's weekend morning. And we are going to come up with the next session. We will schedule for how to bring the money from India to USA. That's going to be a special session. with Anil Garu. We will let you know in advance. So thank you very much, and we are closing the session now. Thank you all.
Thank you. Thank you very much, Srinivas
Thank you,
Garu and
Srinivas.
Madhu specifically for this opportunity. Thank you.
Thank you.
Thank you,
Anil.
Anil.
So you can,
Srinivas
yeah,
Garu.
you have the host privilege now. You can stop the recording and then,
Sure.
yeah,
Thank you, sir.
take it over. Thank you.